Welcome. Selling options, selling puts in particular, is a lot of fun for bargain hunters. When selling puts, you get to collect some premium and potentially buy the stock for a lower price in the future. But is it a good deal? Is it a smart move? When is it a good deal? When is it not a good deal? Those are some big questions, and this episode is only going to focus on one aspect: the risk-free interest rate and how it affects the decision of whether to sell puts or calls. So in this context, are there times and situations when you should not sell puts and prefer instead to sell calls? Let's find out. Here's a potential problem with selling puts. If you look at calls and puts that are at the money with the exact same strike and expiration and no dividend between now and the expiration to muddy the waters, then you'll notice that calls will typically sell for more than puts. So let's go look at some examples of this. But first, if you're enjoying this content, please consider liking and subscribing. Here's some examples of S&P 500 stocks as of close Friday, February 2nd, 2024. I've cherry-picked 3 stocks: CBRE, DFS, and DGX. They closed right on a strike price, so they'll be exactly at the money for these strikes: 85, 107, and 125. I've highlighted the C-P column, call price minus the put price. You'll notice call prices are more expensive than put prices, in all but one special case. This one. In DFS, Discover Financial's 70-cent dividend is coming up soon. That's right before the February 23rd expiration. That's this row. That dividend amount is just enough to overcome the market bias and interest rates to tilt the put price slightly higher than the call price. All other examples here, calls are higher. Even DGX's post-dividend option. It's far enough in the future so that the accrued interest and sentiment is significantly more important to investors than collecting that 71-cent quarterly dividend. So let's think about this intuitively. Why are calls usually more expensive than puts? You might think it's because there's just more demand from the market to buy calls. This is probably usually true. The market is usually biased to the upside, bullish, and rightly so. Over the long term, the market goes up. But it's not the only reason that calls sell for more than puts. Another important reason is because of interest rates. The price of calls already have interest built into their prices, and the price of puts don't. Let's think about this from the context of someone that sells cash-secured puts and also sells covered calls. You're securing your calls with money already spent, or maybe even on margin and paying interest. You bought 100 shares of the stock, so you cannot earn interest on that cash. You're securing your puts with cash. The wise among you will be earning market rate interest on that cash while it's securing your puts. You might be using margin to secure your puts, but you're not paying interest unless and until they get assigned. This is an edge for put sellers, so they'll be willing to sell their puts for a little less than call sellers. And here's where the dark side can show up. If you're securing your puts in super low-yielding sweep accounts, then you are losing money. Your broker is very happy to take your sweep account money and use it in higher earning opportunities while you lose. This is just my opinion. I'm not a financial advisor, but don't have regrets and don't be a loser. Either put that cash securing your puts in a higher yielding account like a money market fund, or if you don't want to do that, or if your broker won't let you, then give up on selling puts and just buy stock and sell calls on it. Then you'll be earning market rate interest because it's built into the option prices of covered calls. This is less a factor when interest rates are very low and market sentiment is bearish. Then the negative sentiment can more than make up for the interest rate premium calls get by default. But you're still giving away interest in this situation if you don't secure your puts with cash earning the risk-free rate. And that's a wrap. If you enjoyed this content, please consider liking and subscribing. Also, let me know what you think in the comments. Do you agree that you should not sell puts if you're not earning close to the market rate on the cash securing your puts? I really appreciate any feedback or comments. I'm not a financial advisor. This wasn't financial advice. Just a brief look at why selling puts may not be the greatest idea unless you can secure them with cash earning the risk-free interest rate. Have a profitable day.